Here's a tip based on new research. Follow the lead of company bosses buying shares in their own firms, but not just any old firms, as Joan now reports.
What to buy, when to sell, how much to sell. Agonizing decisions that haunt anyone betting on the stock market. But now a team of professors from the University of Exeter's Business School has delved into the data and come up with this winning formula. When the bosses of small-cap firms whose shares are considered undervalued buy shares in their own businesses, follow suit. Here's why.
We find that investors that mimic the trades of directors who are buying in value companies typically can make excess returns above a benchmark of between 10 or 20% a year over the next 2 years.
Professor Tonks examined the share trading of UK companies between 1986 and 2003. He divided the equities into cheaper value and costlier glamour shares, then looked at how the stocks performed after company bosses bought them. What did he find? That on average, directors of value small-cap businesses made the biggest returns.
Well, I think directors in value stocks are taking a perspective that they believe the stock market is undervaluing their stock. Directors are perhaps aware of the extent of this misvaluation and take advantage of it by buying.
Okay, so you're probably thinking, what's new here? After all, we know that if you follow directors' trades, you typically make money. It's also well known that value stocks normally do better than glamour stocks. But Tonks says it's the combination of these two strategies that brings in the money.
So the advice for investors would be to form a diversified portfolio tracking directors trading in value stocks. So that probably represents more than twice the return than if you were just investing in value stocks or in following directors' trades by themselves.
So it's like a double whammy strategy.
Indeed it is.
Well, just find out how this strategy actually plays out, and who better to ask than Joan, who's with me now. Jen, give us some specific examples here.
I can give you several examples, but let me just start by emphasizing that the university's research does not cite any specific companies because the research was looking at the average performance of all the shares on the FTSE All-Share rather than at individual companies. But after plugging in the same parameters for a small-cap value company into the Bloomberg here, we identified several securities where the share price did rise above the levels of benchmark index after a company director purchased it. Take a look at Mother Care, for example. One director purchased company shares in January 2008, and today, 2 years later, that share price has gone up by 80%. So that's almost doubling the benchmark FTSE index.
Okay, that's all well and good. You keep on mentioning the FTSE here. What about some of the other indices? Can this strategy work out, let's say, for some of these European benchmarks?
I don't see why not. Professor Tonks says that this kind of strategy could apply to stocks based in any other country, especially in the U.S., where the Sarbanes-Oxley Act has made such trading easier. You'll recall that this legislation, which was introduced in 2002, it effectively cuts the delay for directors reporting trades from 40 days to 2 days. So now you can have a sense of what they're getting up to earlier on.
Yeah, almost straight away as well. Thanks a lot for that. Joan